Namaskaram, ladies and gentlemen. This is CS Sudarsan. Yedunath. Hope you are killing it in your studies. Hardly very few days are left for your examinations. I know that. So I've come up with a very short revision of audit of items of financial statements because this is one chapter that is very tough for students. This is not tough because this is actually tough because you are doing it with the wrong approach. So I'll be giving you the best approach to study this chapter because the problem is that this chapter, every topic looks the same. Every topic, existence, completeness, valuation, you have to check that in for every balance sheet assertions, all these things. So it looks a bit complicated and it is a bit tough for you to remember, right? So today I have a very different approach to study this chapter, and that is through charts. I have structured this chapter in a way that it is very easy for you to understand and very easy for you to remember and recall. So, and we'll be focusing more on the what I would say the important areas of audit of items of financial statements. So before we get into the chapter, let me give you a brief idea about this chapter. What is audit of items of financial statements? You as an auditor went to audit boat company you are going to audit. So the management gave you the financial statements of boat. Just imagine they gave you the financial statement. In that financial statement, balance sheet and profit and loss account, in that there are items like share capital, 20 lakh rupees. I mean, not 20 lakh for board, but still 20 lakh rupees. Land and building, 10 lakh rupees. And P&L, sales, 1 crore rupees. All these figures will be there. So, as an auditor, how you should verify, how you should check, how you should audit each and every item in the financial statement. That is what we call audit of items of financial statements. You saw share capital as 10 lakh rupees. So, what are the audit procedures you need to follow to check whether that is correct or not? That is what we call audit of items of financial statements. So here we have assertions like share capital, land and building, all these things are mentioned. So you as an auditor need to verify that. How you should do that is what is mentioned in this chapter. So if you study this chapter perfectly, next time when you get a balance sheet for auditing, financial statement for auditing, you know what to do in different cases. So first is assertion, and my approach to this chapter would be through charts because everything looks similar in the chapter. If you learn it directly from the book, it will be very easy for you, very hard for you to remember. But this way, it will be each topic will be structured in a very good manner in your mind. So it will be very easy for you. That is why I have used this approach, and you can find these charts in the description box. The link will be in the description box and the Telegram channel. Just join my Telegram channel and take this chart PDF and use it for studying. And focus on this. I'm giving you an exam oriented approach for this chapter. You don't have to learn everything from this chapter, and don't think you can learn all the topic word by word, line by line. No, that is not required in this chapter. We'll focus on only the important areas, and I'll tell you how to study the approach, the perfect approach to study this chapter, how to tackle audit of items of financial statements. So first is we'll move on to assertions. What is assertion? Assertion means the representations by the management. Many of you may know that, but I'm just still saying it. Representations by the management. In financial statement, share capital is equal to 10 lakh. Sales is equal to 10 lakh. This is mentioned there. So that is what we call assertions. What management is saying to us through financial statement by writing it on the financial statement. Management is saying to us that company has a share capital of 10 lakh. Company has done sales of 10 lakh. All these things. That is what we call assertion. There are two types of assertion. That is, look at here, explicit or implicit. Explicit means assertions that are expressly said to us, assertions that are written in the financial statement. Means share capital 10 lakh, land and building 10 lakh is written in the balance sheet. What does that mean? That means management is saying to you that company has a land and building of 10 lakh rupees. Imagine, company don't have a plant and machinery. So in what will be there in balance sheet? Plant and machinery the item will not be there. So what are you understanding from that? Company does not have a plant and machinery, right? In the balance sheet, no plant and machinery is mentioned. So what does that mean? Company don't have a plant and machinery. That is what we call implied assertion, which is not stated because have you ever seen in a balance sheet where it will be stated, company, we don't have a plant and machinery, all plant and machinery equal to 0. They will not write it like that, right? If they write it like that, that is explicit assertion. And if they don't write it, then obviously with common sense we will understand company don't have. That is implicit assertion. Got it, right? So in income statement there are these many types of assertions are there. First is occurrence. Income statement means P&L and P&L. Their sales is equal to 10 lakhs is written there. So that means sale has actually occurred. Transaction recognized in the financial statement have occurred and relate to the entity. Then completeness. All the transactions, all the sales that has been happened in that year that are supposed to be recognized have been recognized. Sales 10 lakh means company had total 1000 sales in 1 year. Imagine company had 1000 sales in 1 year. So in the P&L the figure will be sales is equal to 10 lakh. That means management has accounted all the 1000 sales, right? That is what we call completeness. All the things that should have been recorded have been recorded. Then cutoff. Cutoff means all the transactions that has occurred only during that period. In balance sheet on the head you will see this thing 1/4/2022 to 31/3/2023, right? The accounting period. That is what we call cutoff. What does that mean? All the transactions and balances in that one period is only mentioned in the financial statements, right? That is what we call cutoff. Next year's transaction will not be mentioned in the current financial year, right? Current financial statements, right? That is what we call cutoff. Then measurement. All the amount given in the financial statement is correct. That is, transactions have been recorded accurately at their appropriate amount. That is what we call measurement assertion. Then presentation and disclosure. Transactions have been classified and presented fairly in the financial statements. This is assertion means what are we as users understanding from the financial statements given by the management. Management gives financial statements in which sales is equal to 10 lakhs. What are we understanding that? We are understanding sales has occurred. Sales has actually occurred. All the sales, complete sale has been entered. Sales only during that one period has been entered. That is cut off. Then sales figure, whatever is given is correct or not, is correct, appropriate. Then all the presentation and disclosure of sale is proper. This is what we as users are understanding from that. That is what we call assertions in income statement. In assertions in balance sheet means we will take the example of balance sheet land and building. Land and building is equal to 10 lakhs. So what does that mean? What are we as users understanding from this thing given by the management? Management gives balance sheet where land and building is shown as 10 lakh. What are we as users understanding from it? Understand audit like this. Don't memorize it and go. We'll understand. Then it will be easy for you to learn. Memorizing without understanding is the problem. So land and building 10 lakh means there exists a land and building for the company of 10 lakh rupees. Assets, liabilities. Land and building is an asset. Asset exists at the period, and that is what we as users are understanding from this, right? Then completeness. All the land and building. The land and building 10 lakh means company may have two land or building. One is 4 lakh and one is 6 lakhs. So total 10 lakhs. So the total figure will be here, right? The bifurcation will be in the notes, right? So completeness. All the assets that were supposed to be recorded have been recorded. Same for the liabilities and equity as well. Okay. So all the land and building, all the land that were supposed to be recorded have been recorded. All the land and building has been included. That is what we call completeness. Then cutoff. Cutoff means all the assets and liabilities are reported in the appropriate period. Whatever balance is shown as land and building or assets or liabilities, that balance is of the appropriate period. Normally, for an asset, the balance as on 31/3 of the end of the financial year is what we show, right? What we write in the balance sheet, right? Same. So the balance is only of that period. That is what we meant by cutoff. The next is valuation. Assets, liabilities and equity balance have been valued appropriately. The figure of what the 10 lakh is shown is exact figure. It has been valued appropriately. That is what we as users are understanding from that. When management gives a financial statement where in balance sheet where land and building 10 lakh is written, what are we as users understanding from that? First we will understand existence. That is whether that asset exists. 10 lakh means land and building 10 lakh means company has a land and building. Completeness, all the land and building has been recorded. Cut off, land and building balance of that period has only been recorded. Valuation, the amount has been properly recorded appropriately. Then rights and obligation means land and building 10 lakh is shown by a company. What does that mean? Company owns that asset, right? Or company controls that asset. Then only they will include it in the balance sheet, right? So when a balance sheet if land and building is shown, that means company owns that asset. We are understanding like that, right? So we are reading it like that. When we see that, it means company has. We are understanding it like that. That is what we call rights and obligations. Then presentation and disclosure, whether particular items of financial statements are properly classified, described and disclosed, whether all the disclosures required for the land and building has been properly disclosed, all the presentation, everything is proper. Okay. Now we will move on to the important areas, that is balance sheet captions. How to audit items in a balance sheet. There we have share capital, reserves and surplus, borrowings, assets, liabilities, all these things are there. So as an auditor, how are we auditing that? How we should audit each and every single item. First is share capital. I'll tell you why I have used charts. If you go like this, you can learn it directly from here. Yeah, but there will not be a structure in your head. What are the items in share capital? There are many headings are there. See, share capital, audit procedures is there. Shares issued at premium, what to do. All these different things are there. So if it is in a chart format, the picture of the chart will be in your mind. So you will not confuse, you will not get confused. In auditing, the most important problem is that students don't know which answer to write for which question. That is purely happening because of the lack of structure. So here we are building that structure. I'll teach you how to learn auditing and memorize auditing. So next is share capital. Share capital means audit procedures. These are the general audit procedures an auditor need to follow. When you get a balance sheet, share capital is written there, how you should check the share capital, how you should audit the share capital. Okay, these are the general procedures you need to follow. First is that, just be with me, make your mind calm, start. So, tally. Tally. Tally means tally the year-end share capital balance with previous year audited financial statements. This answer you have to have the pictographic memory, picture of this. Like, and one more thing, there are many points per topic in this chapter. You only need to learn 5 points, because what is a max to max descriptive marks? 5 to 6 marks, right? So 5 to 6 points per topic is needed. Why do you want to learn 10 points? Just learn the easy 5 to 6 and others just read it and go for MCQ purposes. So here we'll only learn this much, right? So tally the year-end share capital balance with previous year audited financial statements. This year's closing balance, tally it with previous year's closing balance. Simple as that. And what this year's closing balance is 15 lakhs. Previous year's audited financial statements closing balance is 10 lakhs. So the difference is there, right? What is the difference? New shares has been issued, some shares has been some bought back or something will be there. So you have to tally there. Why last year it was 10 lakh, this year it is 15 lakh. What happened in between? You have to see that. That is the first step, tally. If there are no changes, last year it was 10 lakh and this year also it is 10 lakh, same. In that case, obtain a written representation from the company secretary that there are no changes. Ask the company secretary, since there are no changes, write it in a piece of paper as written representation and give it to me that there are no changes. Ask the company secretary, that's it. The next point, if there are changes, last year it was 10 lakh and this year it is 15 lakh, so change is there, right? In that case, verify whether the year-end paid up share capital, this year's year-end paid up share capital are within the limits of authorized capital. Because this year the share capital balance is 15 lakhs. See whether it is in the limit of authorized capital. If the authorized capital is 18 lakh, then it's not a problem because it's below that, right? Make sure the paid up share capital is below the authorized share capital. Then 3 points you got. What is the fourth point? Issued. These 2 points are issued. Issued, see, no shares are issued at discount. See that. Make sure no shares are issued at discount. Next is check if shares are issued for cash or consideration other than cash. 2 things. 5 points done. That's enough. That's enough. I'm just saying the other points also. Just keep 1 or 2 points in mind. That's it. More than enough. SEBI. Check the compliance with the SEBI regulations. Verify forms filed with the MCA. Check the compliance with SEBI regulations. When you are issuing shares, when a listed company is issuing shares, they need to comply with the SEBI's regulations. SEBI is the board for guiding all these share capital, shares issue, all these things. So company has to follow SEBI's rules. Simple as that. So see that. Check compliance with the SEBI regulations. Then verify the forms filed with the MCA. When you are issuing share capital or something, issuing or buybacking everything, you have to file a form, file something with Ministry of Corporate Affairs. See that. That's it. Then if there is an increase in share capital, verify whether company accurately calculated the fee and stamp duty payable. When you are issuing new shares, that is what we call increase in share capital. In that case, you have to give some fees to the government, some stamp duty, all these things. See whether it is accurate and correct. That's it. Then copy. Obtain a certified copy of resolution. Authorizing increase or decrease in share capital. If you want to increase or decrease share capital, you will, all the board members, everyone, shareholders will sit and they'll decide in a meeting, right? We are planning to increase share capital, or we are planning to decrease share capital. So once everyone agrees to all that thing, it will be agreed in a board resolution, right? Or shareholders meeting, the resolution will be there. See that, obtain a copy of that, that's it. Then if any fresh issue is there in the current year, if any new shares are issued, then check the compliance with Companies Act. Simple. 5 points. Just keep 5 points. Tally. First is in your brain. Keep it. Tally. In this picture, tally. Then change. 2 cases issued. Done. That's it. Then now pause and get it in your brain. Next is shares issued at a premium. Premium means 10 rupees share is issued for 14 rupees. So 4 rupees is extra company is getting, right? That is what we call securities premium. You learned that in accounts, right? Securities premium. So this securities premium, how should auditor verify it? I'll tell you. First thing is that auditor has to check whether the company has transferred the amount to securities premium account. We are auditing the company, board's balance sheet, right? So as an auditor, check whether this extra 4 rupees, securities premium money, 10 rupee share issued for 14 rupee, 4 rupee extra per share we got, that 4 rupee is transferred to the securities premium account. Auditor has to check that. Next, plus state the purpose to which that amount can be applied. This securities premium of 4 rupees, this cannot be used for all the purposes. This can be only used for some limited purposes. So as an auditor, we will first check whether those amount has been transferred to securities premium account. After that, we will check whether company has used that money only for those purposes that are allowed. What are those purposes? Simple. Look at here. Securities premium money, that is 4 rupee per share, can be utilized by the company only for these purposes. What is that? Issue of unissued shares to members of the company as fully paid bonus shares. When a company gets securities premium account, what they can do is that issue of unissued shares. Company may have certain shares that are not issued to anyone. So issue that shares to the members, to existing shareholders itself, as fully paid bonus shares. I'll tell you, I'll give you the clarity on this. Normally when a company issues share and the shareholder gives money to the company, right? So company is giving share and money is coming in. In this case, money is not coming in. Company issue the shares to them and the existing shareholders itself, instead of taking money from them, there is money lying in securities premium account, right? They'll credit that money. They'll take that money. They'll debit that money to here. That's it. Instead of taking money from them, we'll take money from securities premium account. That is what is written here. Issue of unissued shares to the members of the company as fully paid bonus shares. Simple as. Next is to write off preliminary expenses. What is preliminary expenses? Company registration fees. This one, company registration fee for drafting MOA, AOA, etc. The fees we need to pay before starting the companies. All these things, right? So this securities premium amount can be used to pay off this, write off these preliminary expenses. Then to write off expenses, commission and discount on issue of shares or debentures. When a company is issuing shares or debentures, they have to pay some expenses, commission, discount, everything. So this securities premium account money can be used to write off this. Next is to provide a premium on redemption of redeemable preference shares or redemption of debentures. When we are redeeming the debentures, company issued debentures initially, just I'll give you the scenario. When company issues a debenture or a preference share, 10 rupee comes in. Imagine 10 rupee is the price of a debenture. Company issues a debenture, company get 10 rupee. On redemption, company will give 10 rupee back and take back the debenture, right? So at that point of time, on redemption, sometimes company will give 12 rupees. Company only got 10 in when they are issuing it, but on redemption, company will pay 12 rupees. That extra 2 rupees, we can use it from this one. That extra 2 rupees is premium on redemption, extra money we are paying. That 2 rupees we can take from the securities premium account to pay them. Okay. Then for buyback also, company can use that. For buyback also, company can use that. So as an auditor, we have to verify whether this premium amount, 4 rupees, is transferred to securities premium account and it is only used for these purposes. So how to learn this? First is there is 1 point. Then 2 points relating to write-off, keep in your mind, then 2 other points. Simple as that. Keep in your mind, just picture will be there, right? Whenever securities framing question comes in a paper, your brain, your library in your brain will open up to this chapter. This picture of the share capital chart will come to your mind. And from that, your brain will focus to this area. And from that, you will understand the only two things are there, with this plus this, and downside of that, then purposes are there. And in those purposes, 5 points are there. What are those 5 points? You will get it, you will write it. That is a structured learning of auditing. Then next we have, now take a pause and learn to the past 2 points I have taught you. Next is shares issued at a discount. Shares issued at discount means 10 rupee shares issued for 8 rupees. So 2 rupees discount, right? That is what we call shares issued at discount. So as an auditor, when in a financial statement, if you see this, how should you verify that? What should you do? First thing you have to do is understand this. Company can only issue shares at a discount in 2 cases. Only in these 2 cases company can use. First is if company is issuing a sweat equity share. Sweat equity share means shares that are issued to the existing employees or directors of the company. Existing employees, directors of the company, as a reward to them, because they have been staying loyal to the company for 10 years. So as a reward, company will give some shares. That is what we call sweat equity shares. In that case, company can issue 10 rupee share for 8 rupee in a discount to them. Other case is that if company has debtors, creditors, not debtors, creditors. Company has taken a loan or some money from some creditor, like 10 lakh rupees has taken. There is no way for company to repay that money. So in that case, company will issue company share itself as in a discount to them for like 10 lakh rupees. These are the 2 cases in which company can only issue shares at discount. So as an auditor, we have to check that. So as an auditor, what are things we have to check? First, we have to check the movement in share capital. That is opening share capital, closing share capital. What was the movement in share capital? We have to check that. Then that no shares are issued at a discount. We have to check that the company has not issued any shares at discount. Also check whether company has issued any shares at discount to creditors, because I told you 2 options are there to issue shares. One is to the directors and employees or something, other is to the creditors. So you have to check that. That's it. So, and if company has contravened any of the provisions, means I told you 2 cases only they can issue shares at discount. If they have, in all the other cases, if company issue a share at discount, it is void, it is invalid. So in that cases, if company has contravened any of the provisions, company and every officer in default has to pay this penalty. What is it? Amount raised through issue of shares at discount. Imagine that amount is 3 lakhs or 5 lakhs or 5 lakh, whichever is lower. 3 lakh is lower. So 3 lakh is the penalty company has to pay. Plus company has also to pay refund all the money received plus 12% interest from date of such issue. Company, when issuing shares at discount, will get some money, right? Company has to refund that money as well to those shareholders, to those people, at the rate of 12% interest also. Company took 1 lakh rupee, company has to repay. If it's for 1 year, company has to repay 1,12,000 rupee, 12% interest. Plus this fine to the government also. So don't issue shares at discount. Don't always follow the provisions of company. We have to check the provisions of the proper issue. So next is issue of sweat equity shares. Sweat equity shares, take a pause and study all the 3. Then issue of sweat equity shares. I told you, shares issue. Sweat equity shares means shares issue. Shares issued by the company to employees or directors at a discount or for consideration other than cash for providing the know-how or that you leave it. Shares issued to the directors or employees at discount. That's it. Keep in mind, because sweat equity shares are not that much important. Like what is sweat equity shares, they will not ask you. Then as an auditor, we need to verify 2 things. What are the things we need to verify? First is sweat equity shares issued belong to the same class of shares already issued. Same class of shares. If the earlier issue was for like equity shares, then sweat equity share should also belong to the equity share. That same class. Sweat equity shares issued belong to the same class of shares already issued. Check that. As an auditor, we need to verify this. Then whether following conditions are satisfied. What are those following conditions? These are those following conditions. So this structure, like see, issue of sweat equity share, the structure will be in your brain, right? That is why I've mentioned this chart. First, see whether it is of same class. Then see whether these following conditions are satisfied. What are those conditions? First is issue is authorized by a special resolution. To give a sweat equity shares, company need to get a special resolution. See whether company has got this. That is, the issue of sweat equity share is authorized, allowed by special resolution. Then a special resolution specifies number of shares, current market price, consideration, class of employees or director. This special resolution need to, in that special resolution, it is like a paper, right? In that paper, the paper of special resolution, there will be mentioned. Company has resolved to give this much amount of share to these people, that will be mentioned in the special resolution. So, and it will be signed by everyone. Keep in mind like that, just for your understanding. So, in that paper, these things should also be mentioned. How many number of shares are issued? 10 numbers. Then, imagine this is a special resolution, these things need to be mentioned. Number of shares, 10 shares are issued. Then current market price of the share, 300 rupees. Then consideration, what is the money company, if anything is getting by the company. Imagine like 200 rupees company is getting, simple. Or 1000 rupees, imagine. Then like company is issuing 1000 shares, okay. Then class of employees or directors, what are their class? These things need to be mentioned there. Got it? That is. Then listed shares, in case of listed shares, see if issue is as per the SEBI regulation. I told you, if company wants to issue a listed share, company need to follow SEBI regulations. Same, that's it. Then, if the company is not listed means it is listed in the share market, stock market. If the company is not listed means company is not listed in the share market. That's it. In that case, as per the prescribed rules. So get this thing. Issue of sweat equity shares only to these kind of people. Auditor has to check whether it is of the same class and whether the following conditions are fulfilled. What are those following conditions? See, or the issue is authorized by a special resolution. It has to have the special resolution need this, whether special resolution include all these 4 points. Then if it is a listed share, SEBI regulation followed. If it's not listed, as per prescribed rules. Keep in mind. Then last point of the share capital, we are done with this. This is one of the toughest thing and you have easily learned that. It will anyways take you like around 30 minutes to 1 hour to read and understand this from the textbook. And we have summarized that. So, reduction of share capital. Reduction of share capital means company has a share capital of 10 lakh rupees. Now company is planning to reduce that. Reduce that share capital. In that case, last year when you were auditing, you saw that share capital of the company is 25 lakhs. And this year when you asked the financial statements, when you saw the financial statements, the share capital is 20 lakhs. 5 lakh has been reduced. So as an auditor, how you need to audit that scenario? That is what is mentioned here. So first thing you have to understand is why reduction of share capital is occurring. Why they are reducing the share capital. First is, this is done to reduce the surplus capital to shareholders. Imagine company has a lot of capital. It's a highly successful company. There is no need of expansion. Company has a lot of capital. So company will decide, let's pay some capital to the shareholders and get back some shares. That is one option. Next is to eliminate accumulated losses. Company may have a lot of accumulated losses. To eliminate that, sometimes they will reduce the share capital. Then to restructure the equity, to improve the ratios. For example, to get really good valuation in the business, all these things, they'll reduce the capital. At inter level, you don't have to complicate your mind like that much. So just understand this. No one will ask you all these things. So reduction of share capital means last year company was having 25 lakh share capital. This year it is reduced to 20 lakh. So as an auditor, how you need to verify that? These are the things you need to do. First, verify MAM. MAM, MAM. MAM means meeting AOA and MOA. Just understand this. Verify the meeting of shareholder to pass special resolution has been properly convened. To pass a special resolution to reduce the share cap. To reduce the share capital, shareholders have to pass some special resolution. So for that, they need to sit at a meeting and pass this, right? They don't sit at home and pass. They'll sit at a meeting and pass it, right? Or a virtual meeting or something. They'll sit at and pass, right? So as an auditor, see whether such a meeting has actually occurred. It has been properly convened, properly occurred, conducted or not. Next, verify the AOA, Articles of Association, authorizes reduction in share capital. As per Article of Association, whether the company is permitted to reduce share capital. You have to check that. Then as per MOA, verify the MOA is suitably altered. When you reduce the share capital, you have to alter that in the Memorandum of Association also. So as an auditor, you need to verify three things. These three things. MAM, meeting properly convened, AOA authorizes, MOA altered. Two things. Meeting properly convened, AOI authorized, MOA altered. Three things you have to do. 3 points are there. You only need 5 points per answer. What is, like, it's very easy to learn, right? Then examine Tamil Nadu. Examine TN. TN means Tamil Nadu. Examine Tamil Nadu. Verify ma'am and examine Tamil Nadu. The answer is done. Reduction share capital. Verify ma'am. Verify meeting. AOA, MOA. 3 points. That is, these are actually 3 points, not 1 point. They're 1, 2, and 3. So 4 and 5 done. 5 points. Enough. So examine Tamil Nadu. Examine tribunal. T means tribunal's order. N means no default. Examine tribunal's order and verify that copy of order plus minutes is registered and filed with ROC. To reduce share capital, you get sometimes maybe because of tribunal's order. So as an auditor, you have to verify the tribunal's order and verify that copy of that order plus minutes of the meeting is registered and filed with ROC. If it's because of a tribunal's order, that order plus you will sit in a meeting, all the minutes of those meeting together combined, file it with ROC, Registrar of Companies. Auditor has to check that, examine. Then auditor has to examine that there is no default in repayment of deposits or payment of interest. Company may have accepted some deposit, so company has to repay those deposits and interest also to them, right? So if there is any default in that, company is technically not allowed to reduce the share capital. So as an auditor, you have to check whether company, there is any default by the company in repayment of deposit or payment of interest. Got it, right? Then these points are also there. You just read it because I don't want to waste too much of your time. 5 points per topic is enough, right? Or confirm revaluation of asset disclosed in the balance sheet. Confirm the words and reduced added to the name of the company. If a company is reduced share capital, this word and reduced should be added to the name of the company. So see whether that is there. Then check the compliance with the terms and conditions of tribunal. Check registrar certificate. Vouch or accounting entries recorded to reduce capital and write down assets. 5 points. These 5 points you study. The main 5 points is verify ma'am and examine Tamil Nadu. Verify ma'am means verify meeting. Meeting properly convened. Articles of association properly authorized. MAM. Memorandum of association altered. Verify ma'am. Examine Tamil Nadu. Examine T means tribunal's order. Copy of tribunal order plus minutes submitted and filed to ROC. Then TN. N means there is no default in payment, repayment of deposit or payment of interest. Got it. 5 points. Now structure this thing properly to your head. Share capital. What is the first thing? Share capital. What is the first thing we learned? General audit procedures. The tally, change in whether there is any change in the balances. Then issue 2 points. 5 points. Then next we learned what is securities premium. Shares issued at premium to do. Shares issued at discount. This one. Sweat equity shares. Reduction in capital. 5 points you learned. Done and dusted. And the disclosures of this. Now look at this. This is the everything I've mentioned. Shares issued at premium. Shares issued at discount. Issue of sweat equity shares. Reduction in share capital. Like in my book, there are all other mnemonics also there, but you don't have to study everything. That's it. If someone is interested, you can purchase a book. That's different. All the disclosures you just read from the book that you have. All the disclosures you can just read it. Because how many disclosures can you practically memorize? Whatever it is easy for you, memorize it and go. That's it. Some important disclosures are there. If you go to my book, you can see disclosures where the question numbers will be mentioned. The feature of this book is that every area the question will be mentioned. So when you are studying this area, question number 12, immediately go to the question bank, question number 12, every area it will be mentioned. So you'll easily understand the important topics as well. So go to the question bank, question number 12, read the question. If it is an easy question, cut the question. Similarly, you can reduce the number of questions. It will be very easy for you. Next is, I will focus on reserves and surplus. You got a balance sheet and P&L to balance sheet to audit, financial statement to audit. In the balance sheet, there is an item called reserves and surplus. And the figure is 20 lakhs. So as an auditor, how will you verify that? I'm saying this again and again because majority of the students don't know what this chapter means. Audit of items of financial statement. What does this mean? They don't know. That is why I'm giving you the concept of how it is done. So reserves and surplus. As an auditor, how you will verify the reserves and surplus? Before that, first understand. It's a very simple. First understand reserves and surplus. There are two types of reserves: revenue reserve, capital reserve. Revenue reserve means reserves that are available for distribution to shareholders. money that you can freely distribute to the shareholder. That is what we call revenue reserve. Capital reserve is money that is not available for free distribution. That is, it can be utilized only for limited purposes, just like the securities premium amount we told. Similarly, the capital reserve also, there are certain purpose to it. We can only use that money for that purpose. Capital redemption reserve, debenture redemption, all these things will be there. So it can be used only for that one purpose. Now, as an auditor, what are the audit procedures for reserves and surplus? Simple mnemonic: TSS, DSS. T means tally the opening balance. So this is the points I've made easily, because you cannot memorize it line by line. It is not even practically possible. If you have so much time, I would have requested you to do that, but still understanding this and replicating the same answer in your own words with the keywords is the game changer for this chapter. And I have written it in that way. So tally the opening balance of reserves and surplus to previous year's balance in audited financial statements. Same as we learned in share capital. Tally the opening balance of reserves and surplus. This year's opening balance with previous year's closing financial statements. That's it. Then check if current year surplus or deficit has been added to retained earnings. RE means retained earnings. Check if current year surplus or deficit has been added to retained earnings. Current year profit or loss, what you will do? You studied it in accounts, right? Current year profit or loss, it will be going to the reserves and surplus, retained earnings, right? Make sure that is done. Then ensure this money, ensure it means this point. Ensure this surplus or deficit is also reflected in statement of equity. SOE means statement of equity. Like balance sheet and profit and loss account, there is another thing called statement of equity. So this reserves and surplus, this current year surplus or deficit, profit or loss should be included in that statement of equity as well. Check that. TSS, DSS. T means tally the opening balance. S means surplus or deficit. S means surplus or deficit. TSS, tally surpluses or deficit. Then what is S? Statement of equity. 3 points in your mind. Just close your eyes. Think TSS, DSS. T means tally the opening balance with previous year financial statements. S. What is this? Surplus or deficit. Surplus or deficit. Ensure the current year surplus or deficit is properly included in retained earnings. Then what is the next S? Statement of equity. It is also included in statement of equity. TSS, DSS. D means verify the board resolution regarding recommendation of dividend. D means dividend. D means dividend. Verify the board's resolution regarding recommendation of dividend. When you are recommending a dividend, when the company board is recommending a dividend, they will make a resolution. Verify that. Simple. Confirm whether company issued any share above nominal value. Then verify the board resolution. Shares nominal value is 10 rupees. See whether company has issued any shares above the nominal value. See that. Verify the board resolution. So D, TSS, tally opening balance. S means surplus or deficit properly included in retained earnings. Next S means statement of equity. D, dividend. Board resolution regarding dividend. Verify that. Verify board resolution regarding dividend. TSS, tally surplus or deficit, statement of equity. D, dividend. Next S, two more S is there. Shares above nominal value. See whether company has issued any shares without nominal value. Then next S is security premium is utilized for limited purpose only. Just like we said, securities premium is utilized for limited purpose only. Reserves is done. Close your eyes. Close your eyes. We'll revise it. We'll revise it now. May. So TSS, DSS. T means reserves. Two things are there: revenue reserve, capital reserve. Revenue reserve can be utilized only for, it's free for distribution. Capital reserve can be utilized only for limited purposes, not free for distribution. Reserves, revenue reserve, capital reserve. Audit procedures or reserve. Audit procedures. TSS, DSS. Tally, opening balance. S, surplus or deficit. Next is statement of equity. D, dividend. Verify board resolution regarding dividend. Next is, what was next is? I forgot. Shares above nominal value. Verify company has, confirm whether company has issued any shares above nominal value. Then verify board resolution. TSS, D, dividend. Next is shares above nominal value. Next is securities premium account. Money in the securities premium account is only utilized for that purpose. TSS, DSS, done. So reserves and surplus is also done. Then next is borrowings. There is a fun fact to borrowings. That is, from borrowings, till now in share capital we found like 3, 4, 5 items in like discount, the premium, all these things. In reserves, nothing was there. Just a pure general audit procedure was there. But from borrowing onwards, going now down, borrowing, trade payable, trade receivable, inventory, all these things, there are basically 3 assertions. These 3 assertions are we checking: existence, completeness, valuation. Existence, completeness, valuation. For borrowing, existence means in the now I'll give you the example. You went to audit boat, and boat is growing. Boat is a growing company, but since they cannot get any fund, this is that hypothetical scenario, right? So since boat cannot get any fund, they had a borrowing of around 100 crore rupees. So as an auditor, how will you check the borrowing? In boat's financial statements, balance sheet, borrowing is written as 100 crore. So what does that assertion means? Tell me. It purely means company has a borrowing, that is first thing. Company has a borrowing from that person for 100 crore rupees. This borrowing exists as at the end of the financial year. All these things are there, right? Existence, whether this borrowing actually exists or not. How will auditor check that? That is coming under existence. The procedure auditor need to follow to check the existence, whether that borrowing exists or not. That is existence. Next is completeness, whether all the borrowings of boat is included in the financial statements. We have to have some procedure to check that, right? The completeness, that is what we call completeness. Next is valuation, whether that amount of 100 crores is correct or not. Got it, right? So existence means the simple thing is road retired, that is a mnemonic. Road retired, ROAD, retired. R means review, obtain, AD, retired. This will be very easy for you. Road retired. Road means review the board minute for approval of new lending agreements. Review board's minutes of the when 10 people are sitting in a meeting, one will be writing the minutes, the things that is happening in the meeting. That is what we call minutes. So review the board's minutes for approval of new lending agreement. This is borrowing. Any new lending agreement has been approved or not? Because in a meeting, these people will sit, board of directors will sit, and they will approve any new lending agreements. So it will be, that thing will be included in the minute. So as an auditor, verify that minute whether any approval of new lending agreement is happened. Then obtain, road. R means review. Then O means obtain independent balance confirmations. For all the borrowings, we need to, like we send confirmations in debtors, similarly balance confirmations from those people who have given us borrowings. Imagine a bank has given us 10 crore rupees loan. Ask the bank for a confirmation. They will confirm it in a piece of paper and write and give it to you that this company has taken this much loan from us. Bank will give that confirmation. So as an auditor, you'll be sure that the amount is correct, right? So obtain independent balance confirmation. Ask those bank to give it in a piece of paper. Company borrowed 10 crore from ICICI Bank. Ask ICICI Bank, give a confirmation that this company has borrowed 10 crore from you. So obtain that confirmation and obtain a written representation that all the liability recorded are valid claims. All the liability recorded are valid claims. That is, all the borrowings are actually valid claims. That's it. So road means R, review board minute for new lending agreements. O means obtain. 2 things you need to obtain. What are the 2 things? Independent balance confirmation, written representation. Simple. Then agree loan recorded with a loan agreement. Simple. These points are like very simple. Now itself you learned 1, 2, 3, 4 and 5. Done. This much itself is enough. Agree loan recorded with a loan agreement. Loan is recorded as 10 crore rupees. Ask the company for loan agreement and verify whether the amount both there is correct or not. What is the difference, everything. Then agree means you have to cross check whether both things are correct or not. There are also 10 crore, here also 10 crore. But loan will reduce in the year, right? But whether the interest rate, everything, repayment year, EMI, everything is correct or not. Agree the lease and hire purchase creditors with their agreements. If the company hasn't done any hire purchase or lease, it will be there in the borrowings, right? So that amount and the agreement compare. That's it. 5 points you have learned. Road, ROAD. R, review. Review, what do you want to review? Review the minutes. Review the minutes of board to see whether there are any new lending agreements. R, O, obtain independent balance confirmation, written representation. Then agree, ROA, agree. What do you want to agree? Loan recorded with the loan agreement. Hire purchase or lease with their agreement. Simple. Done. Then for debentures, examine the trust deed. Simple. For debt retired, ensure discharge of secured assets is received. That means company needed 10 crore loan. So when company approached the bank for loan, bank told, give us a security. So company had a building, company gave the title deed of that building to bank as a security for loan. So when the loan is finished, if the loan is finished means debt is retired. If the debt is retired, then this is company, this is bank. Company gave the title deeds and got 10 crore rupees. Okay. So this day, here after 10 years, company paid the entire money. Company paid the entire 10 crore to bank. So now the loan is finished. So company need to give back the title deed, right? So see that just when the debt is retired, ensure the discharge of secured asset. So this title deed is what we call the secured asset, because this is what we have got the loan. So ensure that secured assets is discharged. That means that thing is given back to us. Simple as that. 5 points. Road retired. Road retired. R means review minutes for seeing new lending agreements, obtain independent balance confirmation, return the presentation. A, agree loan recorded with loan agreement, hire purchase creditors with their agreement, ROA. D, for debentures, examine the trust deed. For road, retired means any debt that is retired, ensure the secured asset has been discharged. Simple. Got it, right? Then take a moment, pause it, learn it, then we'll go on to completeness. Next we have completeness. Company had 3 loans. One from ICICI Bank 10 crore, another from SBI 5 crore, another 5 crore from Canara Bank 5 crore. So in the balance sheet, the total loan amount should be 20 crore, right? That is what we call completeness. Whether all the things, all the loan has been recorded or not, all the borrowing has been recorded or not. As an auditor, how will we? Sometimes company will only record 2. Sometimes they'll like hide because of some fraud or something, hide the borrowing from Canara Bank. They can do that, right? Now it's not practically possible. Every data is on digitalized, but still I'm just saying. So as an auditor, how will you check whether bank has included everything, whether everything is complete? First is that obtain a short-term and long-term borrowing schedule. There is something called borrowing schedule for short-term loans and long-term loans. Whether imagine it kind of a paper where the schedule, the opening balance, this much loan taken, this year EMI, this much repaid. So this is the closing balance next year. This schedule will be there. So obtain the short-term borrowings and long-term borrowings, borrowing schedule, and consider any evidence of additional debt obtained through minutes, contracts, or confirmation. See whether there are any evidence of additional debt other than what is included. Consider any evidence of additional borrowing obtained through. How can you get that evidence? Through minutes, contracts, confirmations. Okay. See whether there are any additional debt borrowed. Here you will know some borrowings. See, consider whether there are any evidence of additional debt. Other than this, whether any new debts. Is there any evidence? When you verify something else, you will get some evidence regarding the extra borrowings or something. See whether there is something like that. Okay. Then check the closing balance as per, because I'll tell you, because when you are obtained the borrowing schedule, from the borrowing schedule only 3 loans are there. But when you are going through the minutes, like when you are going through the minutes or contracts, you are identified another new loan, a small new loan taken by the company, 1 lakh, but which has not been included on this. So that is what we will consider any evidence of additional debt. So you got this evidence from minutes, right? That. Then check the closing balance as per schedule to general ledger. The borrowing schedule is one thing, and the company's books of accounts, the general ledger, there will be a balance, right? So both the balance should tally, right? So see the closing balance as per schedule, as per that borrowing schedule, and to general ledger. See whether both are same. Then review the subsequent transaction after the end of the reporting period to determine if there are any unrecorded liability. That is, subsequent transaction means 31/3/2023. The period is end. 1st April or 2nd April, company has taken a new loan. That is fresh loan taken near the end of the balance sheet date. That is what we call subsequent transaction for borrowings. Review subsequent transactions after the end of the reporting period to determine if there are any unrecorded liability. Just review all those subsequent transactions and see whether there are any unrecorded liabilities. Some liabilities need to be recorded in the current year, is not recorded. Just see like that. Sometimes I'll give you a simple example. Sometimes a company has applied for a loan on 25th March, and the loan was actually granted on 31st March itself. So technically it should be included in this year. This is like hypothetical scenario to be included this year, but the company knows that, because company need to get a good valuation, loan should be reduced. So company asked the bank, no, we are not going to take the money today, give it tomorrow. So if 1st April the accounting period is closed, right? So 1st April the company may be taking money. So technically it should be included in the current year because it was granted on the current year. So you have to, when you review the subsequent transaction, you'll understand company received a money on 1st April and that is from a loan that is granted on 31st March. So it has to be written. So similarly, you have to see, review the subsequent transactions after the end of the reporting period to determine whether there are any unrecorded liabilities. So that liability is an unrecorded liability. It should be recorded current year. Money is received at 31st March. The loan was granted at 31st March, even though money is received at 1st April. This is just a hypothetical example for your understanding, not a perfect example. I'm just creating this so that you'll understand the topic. That's it. Then you got it right. First, obtain a short term and long term. Check the completeness, whether we are checking the completeness, whether everything in the current year has been recorded in the current year. So we'll look at this. Now we have the direct confirmation procedure. Direct confirmation procedure means as an auditor, you will directly go and confirm whether the loan is correct or not. Direct confirmation procedure. What is that? Obtain independent confirmation balance of all the borrowings. Direct confirmation procedure means as an auditor, you went and you saw borrowings of 10 crore rupees. Like we said, 10 crore, 20 crore, whatever the money is. You will ask the bank directly. You will ask the bank, give me a confirmation. That is it. Obtain independent direct confirmation. You are directly going and asking the bank, give me the confirmation of, I am the auditor of boat, and it is showing that in boat's financial statement there is a 10 crore loan taken from ICICI Bank. So I came to you to just ask whether this is correct or not. If it is correct, give me a written representation or give me an independent balance confirmation, not written representation, sorry. Auditor will ask for independent balance confirmation, whether that 10 crore is correct or not, give me a balance confirmation. Directly go and ask. Okay, then, and first he will go and directly go and ask this, then see whether confirmation asks for all relevant information. He designs a confirmation request to give to auditor to give to ICICI Bank, right? Whether this confirmation request includes all these things, that is auditor was to see. See whether confirmation, this is confirmation request, confirmation asks for all relevant information, because when you are asking, just company has a 10 crore loan, don't just ask whether the loan is there or not. You have to ask what is the interest rate, what is the due date, what is the security furnished, all these things. So in this confirmation request, make sure all these things are included. Simple. Then send a reminder for non-replies. You send a confirmation request to bank just to give the confirmation of this loan, but bank has not replied after 5 days. So send a reminder, send another mail behind that. Send a reminder for non-reply. Then compare, now imagine you got the confirmation. So here you send the confirmation here, and confirmation should include all these things. And if the confirmation no reply was there, this is how to do. And here you got the confirmation. So here compare balance of confirmation with the books of accounts. You send the confirmation, bank gave the confirmation. The amount is 12 crore. In the books it is 10 crore, but in the financial statement in the books it is 10 crore. But bank told it is 12 crore. So compare the balance of that confirmation with the books of accounts, and if there are any difference, yes, there is difference, 2 crore difference is there. Ask for reconciliation and test supporting documents. 2 crore difference is there. Ask the company. You told only 10 crore is there as per the balance sheet, but bank told 12 crore is there. Give me a reconciliation. Why? What happened? What is the reason behind this? Give me a reconciliation. How that 12 crore became 10 crore in your books? Give me a reconciliation. Done. Got it, right? So to check the completeness, obtain a short-term and long-term borrowing schedule, then see whether there is any evidence of additional debt, then check the closing balance as per the confirmation with the books of accounts, a confirmation to general ledger, then review the subsequent transaction that happened after the year end to see whether there are any unrecorded liabilities. After all these things, now we do the direct confirmation procedure. That is, obtain independent balance confirmation from the bank, make sure that confirmation request includes everything, then send a reminder for non-replies, then compare the balance of confirmation with the books of account, the financial statements, and see whether there are any differences. If there are any differences, ask the company for reconciliation. As simple as that. Done with confirmation, completeness. Now it is valuation. Very easy. Very easy. Very easy. Valuation means whether the amount recorded is correct or not, whether the loan has been valued appropriately. How auditor will check that? Amount is written as 10 lakh, 10 crore, whether the 10 crore, the amount is correct or not. How the auditor will check that? First is determine whether accounting policies and methods. Here the mnemonic is Marco Doctor. There is a new movie called from Malayalam called Marco. Hope you would have watched that, right? If you watched, just comment it in the comment box. Marco. And did you like the movie or not? I don't know. Some may like it, some may feel it horrible, some may cannot even tolerate the movie. It's just like that. I think it is the most violent movie I have ever seen, because I have not seen all these Korean movies. Marco, I think, is the most violent. Oh my God, what can someone do beyond that? Right? So, valuation. Valuation, if you have not seen, after exams are over, I think it is there in Prime or Disney or something. Only after your exams are over. Then, and not at this point of time. Not this movie particularly. At this point of time, you may not even be able to write the exam. So, valuation determine whether Marco, M is first, A-R-C-O, then doctor, Mark M. Determine whether the accounting policies and methods of recording debt are appropriate and consistent. Determine whether the accounting policies and method of recording debt. When you are recording a debt, when you are recording a borrowing, you have to follow certain accounting policies, certain methods, all these things, right? See whether that is appropriate, that is correct, that's it. And consistent. Whatever is done in the last year is done in this year also. Consistently applied, accounting policy and methods. For example, like depreciation, if you take last year straight line method, this year WDV, it's not consistently applied, right? Similarly, like that. Then M means methods, accounting policies and methods, consistently applied or not. M. A, agree the loan balance, loan payable to loan agreement. Agree the loan payable, like a loan balance is written here, loan payable amount, the same, loan balance and loan payable to the loan agreement. See whether both are in agreement. Agree. Marco, M means methods and policies, A means agree, loan balance, loan payables to loan agreement. MAR, recompute the IDD, recompute IDP, recompute interest, discount, premium on redemption if any. Recompute interest, discount, premium on redemption if any. Okay. So to check the valuation, to check the borrowing and valuation, you have to just recompute the interest, discount and premium, because sometimes the interest, they'll play the fraud or something happens on interest. Fraud or error happens mostly on interest. So as an auditor, when you see a borrowing figure, because when company borrows something, company have to pay interest, right? So that money will be, interest amount will be included in the financial statements, right? So just recompute that. Just by yourself, recompute whether the amount is same. You know it is 12% interest from the loan agreement. Just recompute whether the amount is exact 12% amount is shown as interest, etc. Recompute the interest, discount, premium and redemption if any. Marco Doctor. M, methods and policies. A, agree loan payable, loan balance to loan agreement. MAR, recompute the interest, IDP, interest, discount and premium and redemption. MARC, check the computation of amortization on discount or premium. Amortization, check the computation of amortization on discount or premium. Just like depreciation, there is amortization. So check the computation of that. Check the computation of depreciation or not. Check the computation of amortization. Check the computation of amortization. Marco Doctor. M, methods and policies. A, agree loan payable, loan balance to loan agreement. R, review, recompute IDP. Then MARC, computation of amortization. MARC D. Marco Doctor D. CO, computation is CO. Doctor. D means due date. Examine the due date of loan for proper classification between short term and long term. Short term loans mean loans below this 1 year, 2 year, that is what we call short term loans, and long term loans also there. How will you identify a loan whether it is long term or short term? Purely from the due date, right? If the due date of the loan is after 2 years, it's anyways a long term loan. If it's below that, if it's only 6 months, it's a short term loan, right? So examine the due date for proper classification between short term and long term. You have to classify the loans to short term loans and long term loans. So examine the due date for that. Marco, doctor, DR. R means review the borrowing from related parties, ensure compliance with the AS 18 and Ind AS 24. Review the borrowings from related parties and ensure compliance with AS 18 and Ind AS 24. Review the borrowings of related party. Whether company has borrowed any money from the related party, review that and see whether it is done as per the AS 18 and Ind AS 24. Marco, doctor. Methods and policies. M means methods and policies. A means agree. 2 minutes. Just not for you. Accounting, Marco, doctor. M, methods and policies are consistently applied. A, agree loan payable loan balance to loan agreement. MA, agree. R, recompute IDP, interest discount premium on redemption. IDP. MAR. C, CO, computation of amortization. Computation of amortization of discount. Computation of amortization. You have to check the computation of amortization. MARCO, doctor. Due date, examine the due date. Why are you examining the due date? For proper classification between short term and long term. Marco, doctor. D, due date. R means review the borrowings from related parties. Marco, methods and policies. Agree. R, recompute. CEO, computation. D, due dates. R, related party. Got it, right? So we'll see how to audit trade receivables. So first is existence. Existence means in a balance sheet, you went to audit boat, like I said in the example last day, you went to audit boat and their boat gave you the earphone company, they gave you the audited financial, not audited, the management gave you the financial statements, and there in their balance sheet, trade receivable, debtors is there. And debtors balance is like, imagine 30 crore. 30 crore is the debtors balance, just an imaginary figure, bro. So as here, existence, as an auditor, you just have to check whether that debtors are actual debtors or not, whether that debtors actually exist or not. That procedures is what we are going to learn here, existence. So as an auditor, how are you going to check whether debtors actually exist or not? First is whether controls in place, whether there are controls in place to ensure invoices are not recorded more than once and receivable balances are auto recorded in general ledger. So you as an auditor, you have to see whether there are internal controls to ensure that the invoices are not recorded more than once. I'll tell you what happens, because these companies, to inflate their sales, they'll sometimes record one debtor multiple times or something to get more loan from the bank based on debtors. All these things they'll try to overstate their debtors. So as an auditor, you have to check these debtors are not recorded more than once, whether there are any internal control to prevent that. Okay. Then to check that, ask the account receivable aging report and trace balance to general ledger. Ask the management, give me your account receivable, that is trade receivable, that is debtors aging report. Aging report means it's like a report that in that report you can see, like company may have, imagine 10 debtors are there. How long have been these debtors in existence? For example, one debtor is there from a sale that occurred 10 years back. One debtor may be from the last 6 months. Another debtor may be from the last 3 years. So that aging of debtors will be there. So you ask the management, give me that aging report and trace the balance to general ledger. See the balance in the aging report to the general ledger. In aging report, 3 lakh is there. General ledger also, whether same 3 lakh is there for that debtor, you have to check. Then check whether realization is recorded invoice wise or not. That is, I'll give you a simple example for that. See, realization means collection from debtors. Imagine for boat, imagine there is like one debtor, Ram, and he has done sales like, we have done 10 sales to Ram. Like one sale was on we'll put it on April. One sale was on April for 3,000 rupees. Second is on May for 1,000 rupees. Like this, we have 10 sales total, like 9,000, 6,000. All the total comes to 20,000. Imagine it just like that. Okay. So the total comes to 20,000. So when money is received, and another imagination you have to have is Ram has not paid the money till the entire year, not paid even a single money. Debtors is there. Okay. And at the end of the year or the next year, when debtors are there in the balance sheet, he is paying the money, and he paid, imagine, 4,000 rupees. 4,000 rupees. So there are two ways to adjust this. Either you can adjust this 4,000 to the entire 20,000. That is, from 20,000 you can reduce 4,000, that is 16,000 left. Or you can adjust it directly to invoice. That you can say, from the 4,000, 3,000 is for the invoice. So this invoice got cancelled. Another 1,000 is for this invoice. This invoice also got cancelled. So here the same 16,000 balance will come, but you have to see whether that money is adjusted like invoice wise, that like this, or from the total wise. See that, that's it. Check whether the realization is recorded invoice wise or not, whether that money is recorded against the invoice or against the total only, aggregate basis. Okay. Then if any large balance is due for a long time, ask the reason. For example, last 10 years or like 5 years, one debtor is there. He has not paid even a single money. So that balance is due for the last many years, right? So ask the management, what is the reason this guy is still not paying? So these are the 4 things that you have to check for the existence. First is, see whether controls are in place, first thing. Second, ask the management for accounts receivable. See whether controls are in place to ensure invoices are not recorded more than once. Ask the management for account receivable aging report. That is the second point. Next is, check whether the realization is recorded against invoice wise or not. Then if there are any large balance due, ask the management for reason. Simple as that. Then the next is direct confirmation procedure. Direct confirmation procedure. Just hold on to me, because the same opposite of trade receivable is what we call trade payable. It is very easy to learn from this kind of a chart. It's very tough to learn from the book directly. Like if you have, I can give you my book, everything. I can show you my book, but still it's tough to learn from all the books. It's better to focus on the charts, and the link for this charts will be in the description box and Telegram. You can go and take it. Okay, let's join that. Then this is called direct confirmation procedure of trade receivables. How direct confirmation procedure means, as an auditor, you are directly asking the trade receivable, asking the debtors and confirming their balances. Imagine in the company's board, one debtor called Ram, 20,000 balance is outstanding. So you will mail Ram and ask Ram, tell me, in board's balance sheet, it is showing you have to give 20,000 to board. Is it true or not? Then what is the exact amount? Then Ram will confirm that and give it to you in a piece of paper, written representation, written confirmations. Same. So here, what are the direct confirmation procedures? First is, this is the mnemonic you have to keep in mind. Don't reveal RPR. Okay. Then first is, contact the customers directly and ask it to confirm amount to be done for all. Ask to confirm amount. It is to be done for all the significant account balances. Okay. Like I told you. Ask the customer. Contact the customer directly and ask for confirmation. Done. Then do direct confirmation procedure with the consent of the entity only. If management does not give you the consent, ask the management, why are you not giving me the consent? Simple as that. Okay, got it. Then trade receivable request to confirm balances at balance sheet date or date close to the balance sheet date. When you are confirming balances, make sure you are confirming it either at the balance sheet date or any date close to the balance sheet date only, because we want the closing confirmation balance. So that is why we are doing it like that. When you are sending the confirmation, make sure this is either it's close to the balance sheet date or on the balance sheet date. That is 31/3. Then don't reveal. So here have co. First is contact customer directly. Next to consent of the entity. Next to confirm balance at the balance sheet date. Contact customer directly, consent of the entity. What is it? Confirm balances. Confirm balance at the balance sheet date. So Then don't reveal the method of selecting trade receivable to the company till trial balance of the trade receivable is given to auditor. Got it? Don't reveal the method of selecting the trade receivables to the company till trial balance of the trade receivable is given to the auditor. I'll tell you what, there are many methods that an auditor will choose to select the trade receivable for audit procedures. Don't reveal those methods to the company until they give us a trade receivable report. Until they give us a trial balance. Because if we tell them we are selecting on a sampling basis, like the first 50 we will select, then the next 50 we will leave, then the next 50 we will select. Like that, if you say to that, then they will put all the fake debtors or something in those area where we are not going to select, right? So don't reveal all these things to the company till they give. If they give us a trial balance, then they cannot do anything, right? We can do from that. Okay, we can directly select from. So don't reveal the method of selecting trade receivable. Then if there are any related party, RP means related party. So contact the customer directly, consent of the entity, confirm balances asset, balance sheet date or any date close to that. Then don't reveal the method of selecting trade receivable. Then RPR. If there are any related party receivables, that company has sold something to a related party, director's wife or director, company has sold some product to the director, board has sold some earphones to the director itself or the employees. In that case, and he is a debtor, then review their collectibility and whether they were properly authorized and value at arm's length. Because if company is selling something to its employees, boat is selling one premium JBL, not JBL, boat, this boom box speaker, like boom boom, you'll get on trance, that thing. So this boom box, if you are selling this boom box to a customer, to an employee of the boat itself, normally if it is priced at 10,000 rupees, since it's an employee, sometimes we'll give some discount or sometimes even for free. So, but in the book, the entry will be shown as debtor account, debtor to sales will be there, right? So in that case, in case of related party receivables, review their collectibility. That is whether the company will get money from him or not. Is it a free, is it a gift, or is there a discount? What is the collectibility of that? Whether that debtor will pay money to the company, whether that employee will pay money. You have to see that, and whether they were properly authorized. Because to sometimes even accountant and an employee, other employee is like friends. He may take something and give it to him and put some bad entry, right? So you have to see whether those gifts were properly authorized by the senior management or something. Then while the price of that is at arm's length, that is at the normal price or not, you have to see that. So you got it, right? Existence, direct confirmation procedure, don't reveal, RPR, related party receivables. Now I'll give you one like a magic. Let's see. Same thing is for trade payable. Same thing, same mnemonic. So that is why I put the mnemonic. So it will be very easy. 2 questions you'll get on one shot. Similarly. So now we are going to trade payable and seeing the existence of trade payable. Then we will go to completeness of trade receivable and completeness of trade payable. So it will be very easy for you to learn. Now we will think of trade payable. Trade receivable, it was sales. Trade payable, it is purchase. Okay. Existence. In the balance sheet of boat, there is a trade payable of 10,000 rupees, imagine. Trade payable of 10,000 rupees. Like boat has to pay 10,000 rupees. Boat purchase something, boat has to pay 10,000 rupees. So as an auditor, how will you check whether that figure is actually existing or not? Whether that trade payable, whether that creditor is an actual creditor or not? First, you have to check whether there are controls in place. Same point. Controls in place. You have to check whether there are controls in place to ensure that purchase and expenses are not recorded more than once. Simple. Same there. Controls in trade receivable, it was check whether there are controls in place to see that whether invoices are not recorded, sales invoices are not recorded more than once. Here also check whether there are controls in place to see that purchase and expenses are not recorded more than once. Simple. Then obtain account payable aging report and trace the balance. There it was account receivable aging report. Here it is account payable aging report. Okay. Then direct confirmation procedure. Same. There it was contact the debtors. See. Here it was contact the debtors, customers directly. Here it is contact the vendors, because when boat is purchasing something, boat becomes a, that guy becomes a opposite, this vendor becomes a creditor, right? So we have to contact the vendors to ask and confirm the account payable balance. There, as an auditor, we send the confirmation to debtors in trade receivable case. Here we are sending the confirmation to vendors in trade payables case. Okay. Then this should be done for all the account payables. Then do direct confirmation. Same. First is contact customers directly in trade receivable. Here contact vendors directly. Then next is consent of the entity. Ensure that the direct confirmation process is done with the consent of the entity. Contact vendors directly, consent of the entity, confirm balances. Confirm balance, creditors balance. You have to confirm it at the close to the balance sheet date or at the balance sheet date. Right? Same. Don't reveal. Here also don't reveal. Don't reveal the methods. Don't reveal the methods of selecting creditors to the company till trial balance is given to the auditor, same as there. Then if there are any related party receivables, if there are related party payables, if there are any related party payables, then review whether they were properly authorized at the value at arm's length price. Same. Don't reveal related party receivable. Simple. Same as what we learned there. So now I think it will be very easy for you, right? This chart format rather than studying it from a book directly, right? Then next is completeness. Completeness means in the financial statements you saw trade payable, trade receivable as 10,000 rupees. Just a figure I am giving you. Whether company as a like a company board may have thousands of trade receivables, thousands of debtors. The total of that figure, 1,000 debtors of 3,000, 2,000, 3,000, 2,000, 1,000 kind of debtors will be there like this. The total of that figure is 30 crore. And the total will be there in the balance sheet, right? And the bifurcation of all the debtors sometimes may be in the notes. Sometimes if it's small debtors or something. Okay. So as an auditor, how will you make sure that all the debtor figure has been entered in that 30 crore? Sometimes there may be debtors of 30, only 28, of 32 crores, but company may have only included 30 crore debtors. Some names they may have cut down. So as an auditor, how will you make sure? Completeness means all the debtors, all the items are included in that 30 crore. You have to see. 30 crore means the debtors balance in the balance sheet. So completeness, how will auditors check that? First is the entire, this much is the answer point. Okay, I've split this down like this because this is what we call the cut-off procedure. Cut-off procedure means all the debtor balance in that only that all the debtor balance of that accounting period only is recorded here. You have to ensure that all the debtor balance of that accounting period only 1/4/2022 to 31/3/2023, all the debtor balance in that period only we'll record here, right? That is what we call cut-off procedure. Auditor need to satisfy himself about the cut-off procedure. So perform the following cut-off procedure. That is, auditor has to make sure only those debtors are included here. So for that, what are the things he need to do? This is what we call the cut-off procedure. If cut-off procedure for trade receivable, just that thing, one question comes in for 3 marks, write only these 3 points. If it's for 5 marks, write the entire points. Okay. For invoices issued in the last 5 days of the year, 31/3 is the last date. Last 5 days means invoice from 26th March to 31st. For the invoices issued in the last 5 days of the year, for the sales we done, for the invoice we issued on that 5 days and included in the debtors, check whether goods are dispatched. Check whether goods are dispatched. That is, all the invoice that is issued from 26th to 31st March and all those invoice that has been shown as debtors in the books of accounts, see whether goods are actually sent for those invoices. When will you issue an invoice? When the sale is done, right? So make sure the goods are also sent. Ensure that. First thing. Then next thing he need to do is all goods dispatched prior to the year end. That is before the 31st March. All the goods has been sent. All the goods that has been sent before 31st March have been invoiced and included in debtors. The opposite of first thing. All the goods that has been sent, for those goods, see whether invoice has actually been issued and they are actually included in debtors, the amount. Then no goods are dispatched after the year end. No goods dispatched after the year end. That is 31/3 is the year end. No goods dispatched after the year end is included in the current year. That means a good dispatched on April should not be included in the previous year, right? So you have to check that. That's it. No goods dispatched after the year end is included in the current year debtor. If a good is dispatched in the next year, then it should be included as debtor in the next year, not this year. Okay. So these 3 things you have to think. Just think, you will get it. It's very easy. Just draw a timeline like this and see. Just draw a timeline like this. This is 31st March. This is 26th March. So first point is invoice issued. All the invoice issued in this date, in this period, see whether goods are actually dispatched. Then all the goods that are dispatched prior to the year end, that entire goods, see whether invoice is issued. Then next, invoice issued and it is included in debtors. Then goods dispatched after the year end, that is this period, should not be included in this debtors of this period. Okay, keep that in mind. Simple as that. So completeness you got, the cutoff procedure. Next, 4 more points are there. This is what we call Bill Gates gave discount for test match. Simple as that. Bill Gates give discount for test match. Bill Gates wanted to go for a test match. So he had 10 tickets. So only 5 members are coming with him. So he gave 5 test match tickets on discount. Think like that. Bill Gates gave discount for test match. Okay. It's very easy mnemonic. That is why I put this. Assess the bill. Bill Gates means bill. Bill. Assess the bill and hold sales. Examine the supporting documents. Bill and hold sales means you are a company, bought, and a billing happened. Some customer came in, gave us the money. We gave for 1,000 earphones. 1,000 earphones customer gave us the money, and we issued the invoice as well. But the customer told, Aman Gupta, the founder of Bot, told, don't send me the goods now. Send it to me after 3 months only. I'm going to Hong Kong now. I'll come back only after 3 months. So send me the goods only after 3 months. I'll pay you the money, everything right now. So you have bill has already been done, but the sale is actually hold. Sale has already been done, but the goods are actually on hold. We are not sending. We'll only send it after 3 months, right? That is what we call bill and hold sale. So assess those bill and hold sales of both. All the bill and hold sales that happened in the year, assess all that and see their supporting documents, invoices, examine their invoices. Then that is bill. Then Gates, nothing is there. Bill Gates gave, review the process of giving discount and check whether they are as per the company's policy. What is Bot's process for giving discount? For giving a discount, every company will have a process. For a customer, if they bought 4 times, then we'll give 10% discount on the 5th time, right? So every company will have a different kind of policy like this. See whether, I'll review those process and see whether it is as per the company's policies. Okay. See whether all the discounts given in the year is as per company's policy. Then Bill Gates gave discount, that is giving discount. Bill giving discount for test matches. Test invoices listed in receivables report. We asked for one receivables report here, right? No, that was aging report. Yeah, there is something called debtors report. That is receivables report. We'll ask the management side. So test the invoices listed in receivables report. All the invoice that has been listed in the receivables report, debtors report, test that. You have to test that. Then match invoices to shipping documents, shipping or dispatch log. Shipping or dispatch log. Match invoices. When you are selling something, you will have the invoice. So invoice is there. Then when you are shipping the good, when you are shipping that goods, then there is something called shipping or dispatch log, a register or something. You have to match with this. Whether invoice items in the invoice has actually been shipped. You have to match and see. Okay. Compare this. So that is what we call Bill Gates gave discount for test matches. Bill Gates gave discount for test matches. Bill, assess the bill and hold sales. Bill Gates gave discount. Review the process of giving discount. Bill Gates gave discount for test matches. Test the invoices with with receivables report. Test the invoices with receivables report. Bill Gates gave discount for test matches. Match the invoices to shipping or dispatch log. Dispatch log means a register. Okay. Got it, right? Completeness procedure. Now we'll look at the completeness of trade payables. Then next is completeness of trade payables. Trade payables and other similar current liabilities. Completeness. First you have to perform the cutoff procedure. Similarly, there also cutoff procedure. Here also cutoff procedure. What is the cutoff procedure? Okay, look at this. Perform this cutoff procedure. For the last 5 invoices, here it is not the last 5 days. There it was last 5 days. Here it is for the last 5 invoices, record at the end of the reporting period. Last 5 invoice only. If that 5 invoices recorded only on 31st March, then that. If it is recorded on 25th to 31st March, last 5 invoices, only 1 sale per day has happened, then those 5 invoices. Okay. For the last 5 invoices recorded as at the end of the reporting date, and the trade payables also recorded. Invoice has also been recorded, trade payable has also been recorded. See whether goods are actually received or whether risk and reward and ownership transfer to the entity. When will a trade payable happen? When we purchase something, right? So we purchase something on the last 5 invoices we purchase on the day before the reporting date. See whether we have received the invoice. See whether goods are also been received. Just see that. We have received the invoice, see whether the goods are also received. Okay. Then all the goods received, all the goods received prior to the year end should be booked in the trade payable. See that. If we received any good, but the invoice or something, if we received the good, when we purchase, trade payable is happening, right? We received the good, but we are recording the trade payable only on the next year. That is not possible. As an auditor, you have to see all the goods that are received in the current year, trade payable also is recorded in the current year. Okay. 2 point. This is what we call the cut-off procedure for trade payable. Then test the purchase expense on sample basis. Test the purchase and expense bills on sample basis. 1000 bills are there. Take 3 or 4, or not 3 or 4, like 10, 20, 30 and do it on a sample basing test. Then match the purchase invoice date to the gate entry date. I purchased a product on 25th March. And I received the product on 28th March. So when as a company boat earphone company bought certain raw materials for their some plastic or magnets for their product. So this boat, the purchase happened on 25th March and the goods are actually received on 28th March. So when you are receiving good in your factory, there is something called gate entry date. That when the goods enters the gate, there will be one register, security will be there. He'll enter, yeah, this good has been received. So you, as an auditor, you have to match the purchase invoice date plus the gate entry date and match whether the goods are actually received or not. Okay. Then review the subsequent expense vouchers to see if they are related to the transaction in the audit period. That means after the 31st March, there may be some subsequent expense. That is next 3, 4, 5 days, April 1, 2, 3, 4, 5, some expense will be there. And see whether those expenses actually related to our auditing period. That is whether that expense actually related to 31st, actually related to March period. See that. If it is relating to March period, you have to record it in March period, right? Sometimes some expense happened on, imagine 31st or 30th March, a refreshment expense or some printing and stationery expense happened in an office. But the accountant was on leave on that date. The expense actually happened on 30th March, but the accountant was leave on that date. Accountant came on April 2nd only. So he recorded the invoice bill only on April 2nd. It is wrong, right? So as an auditor, you have to make sure all the purchase invoice, the things that are recorded subsequently, see whether it belongs to our period. Okay, that's it. Then for setting statutory dues liability, prepare a reasonability with respect to sale, purchase expense, etc. That is statutory due liability means when you are purchasing something, all the GST, all these things will be there, right? So that is what we call statutory due liability. So in that case, you have to prepare a reasonability report. Reasonability means, imagine for a sale, you have to normally 18% is GST. Just imagine 18% GST is there. So company would have computed all the sales, all the 18% figures, everything. So you just do it once more, do the recalculation again. That is what we call reasonability. See whether thing is there. Just you know the percentage, you know the figure. Just calculate whether the 18% the amount is correct or not. Do the computation again and see. That's it. Then prepare the list of all statutory dues and consider reporting requirement under CARO. Prepare the list of all statutory dues and consider the reporting requirement under CARO. Ask the company, give me a list of all the GST, all the income tax, all the statutory dues liability, the amount the company has to pay to government. Give a list of all those liabilities and see whether any reporting requirement arises on CARO. Okay, you have to see that. That's it. So completeness is also done. Trade payable completeness is also done. Almost similar. 2-3 points are extra, but existence is completely similar. Trade payable and trade receivable. Okay. Now it is valuation. It is very easy. Valuation is very easy. Review the process. Valuation means whether that figure, trade payable, trade receivable, the figure will be there, right? 30 crore. Whether that amount is correct or not. How you will check it as an auditor. That is what we call valuation. Okay. Valuation. Review the process followed by the company to derive allowance for doubtful debts. Not doubtful debt, the provision. Simple as that. Review the process followed by the company to derive allowance for doubtful accounts. That is what is the process of company. What is the process followed by the company for putting all these provisions? For debtors, we'll put the provision, right? Trade receivable, we'll put the provision. What is the process that company follows to put a provision? That is, when will company record a 10% provision for a debtor? When will company record a 30% provision? There may be like, if a debt is overdue for 3 years, then we'll record a 10% provision. There will be some process like this, right? So you have to review those process. Then obtain the aging report of trade receivable, same as that. Then obtain a list of debtors under litigation and compare with the previous year. Litigation means some debtors, we have done some sales. Imagine boat sold 1,000 products, this earphones to Flipkart. Boat sold 1,000 products to Flipkart. In that case, what will happen is that sometimes boat sold 1,000 units to Flipkart, and it was for 1,000 rupees per unit. But once the sale happened, Flipkart says you have to give us a discount. We have bought this much products, right? Boat said, no, that was not on the term sheet when we agreed. Then Flipkart told, we'll see you on court. And they went to court or something. That litigation, the case is happening against a debtor. So obtain a list of all those kind of debtors where the litigation, the case is happening, and compare it with the previous year. Previous year, how many was there? The current year, how many was there? See whether anything was on repeat. Previous year also Flipkart, this year also Flipkart. See all these things. Then check if the provision are made at appropriate rates considering recoverability. Whether provision is made at the appropriate rate. For example, a debtor is overdue for more than 3 years. The company has put only 10% provision. How is that reasonable? If a debtor is not even paid the money for 3 years, at least 50% provision should be there, right? So check whether all the provisions are made at appropriate rates, appropriate percentage, 30%, 20% or not, considering the recoverability. Imagine a debtor is only due for 6 months, but the company has put 70% provision. Why is that? And similarly, on another debtor who is due for 3 years, but only 20% provision. It's not reasonable. Check all those things. Then check whether write-off of trade receivable. I'm giving you practically examples. So check whether write-off of trade receivables are approved by appropriate authority. One debtor, imagine, I'll just give a situation so you'll understand. A company, accountant has a friend. Accountant or the management, some people in the management has a friend who is a debtor to the company. And this debtor is not paying to the company. So because of the friendship, what guy in the management did is that this debtor will not pay. So we'll write it off. Company will write it off. For doing a favor for his friend. That is not like allowed, right? So because if you are writing off something, you need the permission of the senior authority to write off some debtors, right? So you, as an auditor, see whether all the write-off of trade receivable is done under proper authority. That is sanctioned by approved by the proper authority. Only the top people in the management can approve which debtor will not pay or something, right? So see whether all the write-off is as per the approval. Then identify the debtors which appear doubtful and discuss with the management the reason as to why it is not included in provision. Identify the debtors which appear to be doubtful. It is not included as doubtful. Some debtors, it may not be included as doubtful debts or provision has not been made. But as an auditor, you feel like this debtor is in existence for 3 years. But company has not put a provision for that. Why? Company has not put that as a bad or doubtful debt. Why? So you have to identify all those debtors like that which appear to be doubtful for you and consider and discuss with the management, why have you not put provision for them? They are in existence for 3 years. Why have you not put provision? Simple as that. Ask the management. That's it. Done. Okay. Valuation is also done. Then similarly, valuation at trade payable. Valuation for trade payable. Review the process followed by the company. Same. To identify all the creditors balance that need to be written off. What is the process followed by the company to identify all the creditors balance to write it off? Simple. Then obtain aging report of trade payables. Obtain a list of vendors with whom dispute is there. Same as litigation there. Dispute is there. Obtain customer claim under litigation. Same as there. Same thing. And compare with the previous year. Then check the write-off of trade receivable is as per approved by senior management. Same point. Same also here also. Check whether write-off is approved as per senior, approved as by the proper authority. Then check the restatement of foreign currency trade payable done properly. Company, imagine boat itself. Bought some 1,000 kg of steel or raw material or something, not steel, some plastic or magnets for their earphones from China. It was from a different country. And creditor, China, the company, Shengfeng Plastics, that is a company, just keep it like that. So Shengfeng Plastic is a creditor now, right? board has to pay to that creditor. And you have to pay the money in Chinese yen, Chinese franco, whatever it is, what the currency. Yen is on Japan, sorry. Chinese dollar, Chinese currency. What is that? What is the Chinese currency? I forgot. We'll just check. What? You are understood, right? So Chinese currency. Company has to pay it in the Chinese currency. Imagine the amount is, just imagine it is in dollars. So board has to pay $1,000. So this has to be restated at the end of the balance sheet at our rupee, right? Imagine the rupee is like 70, so it is 70,000 rupees. See whether this restatement has been done properly. See whether the price was, here the dollar price is equal to 70. See whether the dollar price was calculated properly. That's it. Restatement of foreign currency trade payable done properly as per AS 11. Then management's process to identify the principal and interest due remaining unpaid to the MSME suppliers at the year end. Management's process to identify. Here management, what is the process followed by the management to identify the principal and interest due, principal and interest that you have to pay, that is remaining due to be paid to the MSME suppliers. Some MSME supplier gave us something, some product we bought from MSME supplier. What is the principal and the interest we have to pay to them? What is it? How much of is that remaining due? What is the management process to identify that? Okay, then at the year end. So hope you got with the valuation as well, right? So trade receivable and trade payable, we are done. Hope you got an idea about that. Then next is cash and cash equivalent. Inventory we'll do it later because we'll focus on the easy stuff now, because that is how we need to go. The cash and cash equivalent is there. Cash and cash equivalent. Here for existence and completion, same procedure is what we are going to follow. For existence and completion, same procedure we are going to follow, and valuation is also there. So what is the procedure for existence and completion? Simple as that. We'll see. First, that is in the balance sheet, there is a cash and cash equivalent amount of 10 lakh rupees is there, or 20,000 rupees, whatever, the 10 lakh rupees is there. So as an auditor, how will you make sure that actual cash balance there is 10 lakh rupees? What is the existence of that cash balance? How will you audit that? And how will you audit the completeness of that cash balance? The entire cash we had is accounted in that 10 lakh or not? So that is existence and completeness procedure of auditing. First, you will do a surprise check. Not only on the last day of the year, check again after close of the year without giving notice. That means on 31st March, you'll directly go and do the normal cash balance check, right? They're saying it is 10 lakh rupees or not 10 lakh, put it 10,000 rupees. So we'll check it, right? Not only do the checking on that date, do it on some other date also on a surprise basis, because obviously they know on the last day you will be coming. So whatever balance of cash is as per the books, if as per the book is 10,000, they'll put the exact cash of 10,000 also in the drawer. So it will match. But that day anyway, because they know that. But if you do that on another surprising day, sometimes as per the book it is 10,000 and sometimes some cash may not be there. Sometimes the accountant who is handling the money may have taken like 2,000-3,000 rupees to roll. You have seen the movie Lucky Basket, right? For rolling for 2-3 days or something, they may have taken some money from the cash. So do a surprise check on a day, not only on the last day of the financial year, but also on some other dates without giving notice. Should be surprise. Then if more than one cash balance is there, then check all the cash balance simultaneously. So shortage in one is not made good by transfer from other. If a company is spread over like a 3-acre land and there are many departments. So in certain departments itself, we have a cashier is there. In one department, one cashier, another department, another cashier, another department, another cashier. So 3 cash balance will be maintained by some of them, right? So when you are doing the checking, make sure you simultaneously check everything. You check everything at once itself. Send one article to check that, send another article to check this, send another article to check the third cash balance also. Else what will happen is that if you only check first and then you are going to check the second, what will happen? If here 10,000 is the amount in the books and 10,000 cash may be there. Sometimes there may be 10,000 cash. But once the checking is happening here, this guy will know auditor is coming to check him. So once the checking is done here, before the auditor reaches from here to here, what will happen is that this accountant will take that money and come to here. take that money and come to here and use it here also. If there is any shortage here, he'll put, if imagine here also the account balance is 10,000 as per the books, but only 8,000 is there in the drawer. So this accountant will suddenly come and give 2,000 here. So to balance it, right? So it should not happen. Here the amount is 10,000. So you may think like the accountant can put 2,000 from his pocket also, right? Bro, it's 10,000. They can do that. Imagine if it's 10 lakhs. What will you do? So make sure you're checking everything at once itself. Tuck, 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 finishing it. Okay, got it. Got it. Then it is desirable that the cashier to be present when counting. Else what will happen? Imagine you are the auditor of boat and you told Aman Gupta that I will be coming for the cash counting on 30th March. I will be coming. So what happened? Imagine the cashier is a fraud and he may have done some fraud. So he'll tell Aman Gupta, sir, I am having stomach issues. I have taken leave. I just want to leave on 30th March, and he too went on a leave. And auditor, you are coming and you are checking the cash balance. So cash is also there. You are checking the cash balance. What will happen? As per the cash book, the balance is 10 lakhs, but when you are checking, the balance is only 9,80,000. The cash there. Sometimes the accountant may have, the cashier may have taken 20,000. But when you say this to Aman, when Aman scolds this cashier, do you know what will cashier say? No, Aman, the money was there, 10,000 was there, I have kept that. It is auditor, the article student. The article is the one who's checking, right? The article may have taken 20,000 and putting the blame on me. They'll say like that also. So make sure the cashier is present when you are doing the checking. Else he will held the auditor responsible for any fraud or something. Then if there is any rough cash book is there, then test it with the normal cash book also and provide entries both are correct. Because I'll tell you, simple case. Imagine if it's a small office or something where two cash books are maintained. One is a neat and clean cash book where the entry will be made by the good handwriting. The accountant will make the entry. But there are the other staff in the office, they need petty cash expenses. So they'll maintain the cash in a rough book because they don't know the accounting entry or something like that, right? So if there is any rough cash book and main cash book, make sure you check both. If rough cash, test it with the normal cash book. Make sure all the money entry in the rough cash book is there in the main cash book also. Then obtain bank reconciliation statement of all the bank account of the entity. Company had 10 bank accounts, ask the reconciliation statement of 10 accounts. Okay. Then next is a direct confirmation procedure. Contact the bank and ask for confirmation. Same there. Contact the supplier, contact the customer, we learned. Same. Then if there is any discrepancy, ask the company to investigate. You, as per the company's book, the bank balance of SBI is 10,000. Just imagine. And you send the confirmation to the bank and bank gives the confirmation as only 9,000. So ask the bank, ask the company, what is this 1,000 rupees different? You say you have 10,000 balance in SBI, but SBI is saying only 9,000 is there. Ask the company for ask the company to investigate and reconcile that. Then auditor emphasize for confirmation of 100% bank balance. If no reply received, then perform additional testing of balances. I'll tell you what it is. 10 banks are there. Make sure you need the confirmation of all the 10 balances. Auditor should emphasize for confirmation of 100% bank account balances. 10 balances are there. 100%, that is 10 bank accounts you need confirmation. And if you don't receive any reply, then perform additional testing of balances. Like if there are 10 account balances, you send confirmation to all the 10, but only 7 banks replied. Some others, no, some 3 of the banks not replied. In that case, you need to do additional testing. What is that? Agree the balance in books of accounts to bank statement. Because anyways, you are not getting confirmation. But you may have the bank statement, right? So agree the bank statement to the books. That is what you can do. Agree the bank statement to books. Then send audit team member along with the entity's personnel to branch to get the confirmation directly. You ask the confirmation through mail and they have not replied. Now what you need to do? Now ask bot, send one more person, because I am sending my article. Auditors will send you his article, and ask Aman Gupta that send one person from bot also along with this article to get the confirmation. Because if only article goes and ask the bank, I am the auditor of bot and I need a confirmation of bot, bank will not give. Someone from bot should come with authorization letter, then only they will give the confirmation, right? Sometimes. So for that, send the audit team member along with the entity's personnel also to get the confirmation directly. Got it, right? Existence and completeness. You'll receive this PDF of this in the Telegram channel. Just join there. Okay. The next is valuation. All the procedures performed till now. Valuation means that to check that the amount is correct, amount of trade receivable is correct or not. All the procedures we did till now. That is all these procedures plus all account holding foreign currencies restated at the closing exchange rate. You just have to check. If the company has any bank account or somewhere where we hold foreign currency, when you are making the balance sheet in India, you will make it in rupees, right? So the restatement happens properly. Make sure that the proper dollar is, the conversion from dollar to rupee was proper. Make sure. That's it. Hope you got cash and cash equivalents also, right? Next we'll go on with inventory is there, PP is there, intangible asset is there, done. Then we have the sales, all this. Loans and advances also there, provision also, we'll do that.